Assalamualaikum and hi everyone. Welcome back. This is the third presentation on Mfrs 102 inventories, and in this session we're going to look at the inventory system and basis of inventory valuation. Inventory system. Companies may need some kind of system to track everything that they have in their inventories. So therefore, the so-called practice used to accomplish this is called an inventory system. And inventory systems that are typically used by companies are normally the perpetual inventory system and the periodic inventory system. So let us look at the first one, the perpetual inventory system. Under this system, inventory account is continually updated for the movement inventory items. And as you know, the term perpetual inventory system may have been familiar to most of you, as you have learned this in your earlier financial accounting studies. So in this session, we'll be quite fast to proceed with this two inventory system. And under the perpetual inventory system, again, at the date of purchase, cost of purchase are being added to the inventory account, and at the date of sale, the cost of inventory sold is deducted in the inventory account. Inventory amount at any point in time can be determined directly under the system from the books of the entity. Either that is done manually, or sometimes they use some kind of computerized accounting system to record the inventory. Inventory count may be undertaken to verify the inventory amount. Under the system, each result in terms of the sales result will result in a matching of revenue and cost, as the cost of inventory sold is transferred to the trading account on each sale. And this will provide a better control of inventories, and however, they are more expensive to administer in terms of time and record keeping. So let's look at the journal entries, or the some kind of revision on those journal entries that you may have learned earlier on the perpetual inventory system. So on purchase of inventories, as I mentioned, you are going to debit inventory and credit cash or bank. If the accounts payable is being credited, that can be the case if you purchase on credit. But if the cash is the one that is involved, you will either credit cash or the bank account. On sale of inventories, these are the journal entries that will be involved. Where normally the credit sales or the cash sales will be recorded depending on what to be debited, but the sales account will be credited, and the cost of goods sold will also be adjusted with the credit to the inventory account. Under periodic inventory system, the account is only updated periodically after an inventory has been undertaken. So this is actually the second inventory system, periodic inventory system. At the date of purchase, this is recorded in the purchase account. And at the date of sale, the inventory, no cost of inventories are being recorded in the inventory account or cost of goods sold account. So inventory amount at any point in time cannot be determined directly from the books of the entity. If you look at periodic inventory system, inventory accounts are being undertaken periodically when income are being measured and when the inventories are being valued. Cost of goods sold is determined by this equation. This might be familiar to you, where opening inventories plus purchase minus closing inventories will give rise to the cost of goods sold or the cost of sale. Weaker control inventories, that is the impact of the periodic inventory system. However, it is less expensive as compared to the perpetual inventory system. So these are the pro forma journal entries that you may have done that before earlier So this would just be a revision on the pro forma journal entries for the purchase of inventories, debit purchase, and credit cash or bank, or maybe credit accounts payable, depending on what are the purchase made of. Is it on cash or on credit? On sale of inventories, the sales account will be credited, and the account that will be debited will depend on whether the cash sales or credit sales. So bank account if it's a cash sales, accounts receivable if that is a credit sale. So for example, you can refer the example 9 at page 259, 7 edition textbook. And for details, you can also refer to 7.2.3.1 in the same textbook. After inventory count has been undertaken in terms of the journal entries, the debit will be done to the cost of sold, and the opening inventories, which is the inventories from the prior period, will be credited. And the cost of goods sold will also be debited, and the purchase account will have to be credited in order to close the purchase account. And the next one is that the closing inventories after each inventory count will have to also be debited, right, and being credited to cost of goods sold. So those things you can refer the example as I mentioned at page 259, and you can also go through your earlier examples or earlier studies notes that you may have kept, and go and make your revision on this. Let's go to the basis of inventory valuation. In terms of basis of inventory valuation, Mfrs 102 prescribed that on reporting date, the MFRS actually requires the inventory shall be measured or shall be valued at the lower of cost and at the net realizable value. Lower of cost and net realizable value. So there are two important words here, which is cost and net realizable value. Cost, as you know, are those that we have earlier discussed when we talk about cost of inventories. So the new thing here is the net realizable value. So we are going to look at the measurement by looking at of the two cost and net realizable value, which one is the lower. So it will be measured at the lower of cost again and the net realizable value. So let's say we have one example to illustrate, but before that, let's look at net realizable value itself. Net realizable value, according to the MFRS 102, it is actually the estimated, so it involves estimated selling price of the inventory in the ordinary course of business. So ordinary course of business are your normal business activities, right, dealing with the goods that you purchase, held for sale, right, and less any cost of completion. So this must be deducted, the cost of completion, as well as deducted with the cost necessary to make the sale. Some important highlights here is that NRV, or the net realizable value, is the entity specific value. This is not the same like fair value, which is more on market base. NRV may not equal fair value, less cost to sell. You need to take note on that. May not equal. And then the estimates of NRV are normally based on the most reliable evidence available at the time the estimate are being made. So it is an estimate, but it is a reliable estimate at that time the estimates are made. Let's look at the example 4, where you have a cost of inventory. So let's say the cost is 200 and the net realizable value is 250. Remember, the inventory valuation will be measured at the lower of cost. So the lower of cost, so the lower between the cost and the net realizable value. Which one is lower? So we'll be looking at which figure is lower. So in our case here, you can see that the cost is lower, the 200. So therefore, according to Mfrs 102, the inventory shall be measured or valued at cost. So if this is the case, there is no adjustment needed to the inventories, and therefore there is no write down needed since the cost is lower than the net realizable value. So the most important highlights here is that the issue is you need to select which one as the value is the lower value. So in this case, the cost is lower than the net realizable value. So there are no adjusting entries needed as there is no write down of inventories. Next, example 5. This is where the cost is, let's say cost is 200, while the net realizable value or the NRV is 170. And here you would see that the NRV is actually lower as you compare to the costs. And therefore, the inventory shall be measured at the net realizable value, valued at 170. As again, the tips is to select the lower value. In this case, the NRV is lower than the cost. Which one is lower? Next, what happened is that when NRV is lower than the cost, we need to state the inventory value in the financial statement, which is in the statement of financial position under current asset at its net realizable value. To do this, it requires a write down of inventories by the amount of 30 ringgit to be expense of in SOPL, and this will also be added to the cost of sale. So in simple word, this is where you are going to debit cost of sale in the SOPL, and you are going to credit the closing inventory, and this is the closing inventory that appears in the statement of financial position by the write down amount, which is 30 and 30. And with that, your inventory is now reduced from 200 down to 170, which means that it is now stated at the net realizable value. And writing down of inventory to the net realizable value normally occurs when inventories were physically damaged, let's say due to the misplacement or ineffective inventory management strategy, or maybe some ineffective security measures. It can also be reduced down to the NRV, net realized value, if the inventories have become either wholly or partially obsolete. This might be due to the market trend shift, such as the introduction of a new model of a product, that the old product will no longer be in trend, right? Next is their selling price may have declined. The selling price of the inventories may have declined due to the decreases in the demands from the customer. So when there are no demand, normally the selling price would have to be declined to attract more demand. So that has happened, and these are because of the consumer power. Next is looking at the methods of writing down inventory value. So to write down the inventory value, as I've shown here earlier, where we debit the cost of sales, and when we credit the inventories, it can be done using this two writing down method. There is the first one, an item by item basis, and the second one is group of similar item basis. We shall illustrate this in an example, but before that, let us look at the explanation of those bases. An item by item basis are normally used where in most circumstances these are the more appropriate one, but it might be tedious somehow. Group of similar item basis is more appropriate in the circumstances or in situation where you have an inventory that relates to the same product line, to the similar purposes, as well as they are marketed in the same geographical area. So we will be looking into this in our example. So let's look at the example that were taken from the textbook, page 262. You can just go and take your textbook and look at the page which I mentioned, example 10. So I'm just extracting the information here. Go and take your textbook. PQR Berhad has the following items of inventory whose costs and NRV is being given here. So NRV and the cost is given. You don't have to calculate. In circumstances, you may need to do the calculation yourself. And here they are the information on costs and the NRV. So these are the costs and these are the NRV. Remember, this is the one given, and you can see that it is having item which are 9 item here, A, B, C up till I, and item A, B, and C is under group 1, item D, E, F is under group 2, item G, H, I is under group 3. So these are the grouping that has been done, where the item were categorized according to the group, and you also have the cost according to the item. Right, so the total for the inventories are 2.2, 2,200, and the NRV was 2530. That was the situation. But under MFRS 102, in the example that I just showed, the NRV test has been applied on the total inventory basis. So if that is the case, that is not allowed by the MFRS, where you cannot apply the NRV test on total inventory basis. So if that is being applied, you would notice that the cost was 2.2 million. If you can go back here, yeah. And the NRV was 2530, and therefore NRV is higher than the cost, so there is no write down needed. However, what is more important is that the total inventory basis is not allowed by the MFRS, so do not do the total inventory basis write down, or there is no such thing as total inventory basis which is allowed by the standard. So what is required in this question actually? You are required in accordance with MFRS 102 to compute the value of closing inventories to be disclosed in the statement of financial position. You need to go and compute what are the closing inventories that you will need to show in the current asset section of your software, and also what are the amount of write down, basically knowing what to be debited to the cost of sale and what to be also credited to the inventory account should there be any write down. You are going to use the item by item basis for the first round, and in the second round we'll be doing the group of similar item basis. Let's start with the first one, writing down the inventories on item by item basis. This is easy. So let's look at the situation. Recall again that inventory shall be measured at the lower of cost and the net realizable value. So you need to go and look at which figure is the lower figure, and that is going to be the figure to be included in the closing inventory. So let's look at the item by item basis. If you talk about item by item, you will go directly to the item. So there are all together 9 items. Here 9 items, right? So we'll be looking and comparing the NRV and the cost of each item. This is item by item, regardless where the group is. So A, B, C, D, E, F, G, H, I might be in different groups, but you are now comparing item by item. So if you do that, you will see that for the first one, the cost is lower than NRV, so the closing inventory is at cost. For the second one, again the cost is lower than the NRV, so the closing inventory will be measured at cost as well. No write down is needed. For the third one, the net realizable value is lower than the cost, so the closing inventory will be valued at 260, and for that reason you need to go and write down the amount 40, which is the difference between cost and the NRV. Same goes for D, where the NRV is lower than the cost, so you need to go and write down 20. For E, the cost is lower than the net realizable value. Same goes for F. The cost is lower, so no write down is required. For item G, the NRV is lower than the cost, so there is a write down of 30. You need to go and adjust that. And then item H, the NRV is lower than the cost and the difference was 50. This need to be written down. And the inventory for G and H are valued at NRV. For I, the cost is lower, so we will value them at cost. So what you would notice is that these are at NRV. These are at NRV. And the rest here is value on cost, as well as here also on cost. So there is a mixture of cost and NRV according to the item by item basis. So what is the total inventory that is being written down? You can just do the casting here. You would get 140 by adding up all this. You'll get 140. This is the one that must be written down. So let's look at the accounting treatment. How do we explain? Of course, inventory shall be measured at the lower of cost and at the net realizable value. So the value of the closing inventory that will be shown in the SOFP under current asset will be recognized at the 2060 here, which is the total of the closing inventory value coming from the items that you have here from A to I. However, there is a need for us to write down the 140, and that should be recognized as an expense, recognized under cost of sale. So this should be recognized under cost of sale, and the write down is being added. Cost of sale is an expense and it will be deducted from the closing inventories in the SOFP. So in the SOFP, you will report 2060. So these are the presentation, and before that, these are the write down that is needed for the total 140. Debit to the cost of sale in the SOPL, increase the expense, credit to the inventory, reduce the asset down to 140 because of the write down. The presentation, the cost of sale should be added by extra 140. Look at the original cost of sale. If there are some amount, go and add this 140 to the cost of sale. For the statement of financial position, the current asset, before this, the cost was 2.2. Cost here refers to this 2.2 here. And now it is written down to 2.06, which is the closing inventory value. So it was written down by 140 written down. So that reduced the inventory to 2.06. And the group of similar item basis, what you are going to do is you're not going to compare each item, but we are going to get the total from each group. So if you can recall from our previous example, the same example, you have the detail of the group. So if you look at the detail of the group, each group has its subtotal. So what you need to do is to go and total up the cost of the first group and also the NRV of the first group, like what have been done here. You proceed for all three groups. So they are all together 3 groups, right? Group 1, 2, and 3. After you have done that, we are going to compare. You're not going to compare each item, but you're going to compare each group. So subtotal of group 1 is 600, right? 600 for on cost, but NRV is 690. So 600 will be the closing inventory. The subtotal of the group 2 is the cost is 900. The NRV is 1180. Again, it will be at cost for both that you have here. And the last one, group 3, the subtotal for cost was 700 and the NRV was 660. So the inventory will be valued at 660. That is the NRV. And only in group 3 that there is a write down. So write down total again would be 40. So the inventory now is under the group of similar item basis being valued at 260. So therefore inventories again in terms of accounting treatment explanation should be the case where inventory shall be measured at the lower of cost and the net realizable value, and therefore the value of closing inventory in the statement of financial position under the current asset is recognized at the net realizable value, which is 2160. The write down of inventories need to be done by recognizing that as an expense in the year where it is incurred. So the write down of 40 because of the difference between costs and the NRV. This cost with the NRV total. The cost here is 2,200 with the closing inventory value, not NRV total, because only one NRV and two costs that were being included in the closing inventory. So it is the closing inventory total. And the write down of 40 is added to the cost of sale in SOPL, and it will be deducted from the closing inventories in the SOF-P. So closing inventories will be credited and the cost of sale will be debited. That's it. We'll continue with this in our next video, the net realizable value test for raw materials. Till then, I'll see you when I will see you. Thank you for watching. And with that, Assalamualaikum and bye-bye.